Brilliant. So the recording for this tax processes for business revision session is now underway. And in tonight's session, we're going to be taking a look at tasks 4, 5, and 6 respectively. So let's start at the beginning, which is task 4 for tonight's session. Now it says here that this one's going to be about preparing, calculating, and adjusting information for VAT returns. Now, spoiler alert, you are going to get VAT returns in some iteration or capacity in this assessment. There are a few things that you won't be expected to do, but again, as we're going through the tasks, I will point those things out. Because we notice there it says preparing, calculating, and adjusting information for a VAT return. It doesn't say you're sort of completing a full one. So for example, boxes 2, 8, and 9, the information we've got from the AAT is they are not assessed. Okay, again, we're going off the information the AAT give us, which admittedly has been a little sketchy for this unit at times, but again, shouldn't be an issue. So in terms of, again, what can come up a bit more specifically, we need to understand the documents and sources of information that we need to complete a VAT return. Basically, what is it comprised of? So again, you'll, at this point, I'm sure, have a rough understanding of what goes in each box, but where does the information come from? So we know the boxes is the end point, but to get the figures to put in the boxes, what do we need to find those figures? What different types of source documentation? Input and output tax from gross or net amounts. Again, truthfully, pretty straightforward. You can either going to be going from gross to net or net to gross. Again, this has been in AAT since like level 2 bookkeeping. It's just we're now looking at the tax element a little bit more specifically. We can also aim to demonstrate how we deal with errors when preparing the VAT return. Again, errors is certainly one of those sections that does pop up repeatedly. So there'll be errors in terms of like correcting the errors, and then the sort of the penalties and surcharges that can come with errors, which we'll see maybe not in tonight's session, beg your pardon, in next Tuesday's session. So again, we'll see the different types of errors and the logistical side of it as well. Okay, and also understanding the implications of imports and exports, which always throws people off, but it's painstakingly dead forward. There's like 2 lines in the course notes. If you are an FI course notes user, it's around page 62, 63, I believe. And again, it's just a couple of lines that you need to just drill into your head, because as you're going to see, like a lot of what we covered in Tuesday's session, the reference material is going to be our best friend. It's going to really give you guys a real crucial element of comfortability in this exam. Certain things will be covered, certain things you don't need to remember, which also means you've got more brain space to remember what is important and what isn't listed. But again, as we're going through, I will tell you when things are in the reference material for your reference. Pardon the pun. Okay, let's get into it. Task 4. Rosetta Limited prepares VAT returns for the quarters ending the 31st of March, 30th of June, 30th of September, and the 31st of December, and does not use a specialist scheme. Okay, so straightforward, 4 different VAT returns, no special schemes, we're just on the standard one. Eddie is assisting with the preparation for the returns for the quarter ending September 21. We're asked to identify which one of the following records are not required for Eddie to prepare the VAT return for the quarter to September 21. I've got 3 options: inventory records for September, sales invoices for August 21, bank records for July 21. And what I am going to do is I'm going to up the ante a little bit, put reconciliation here too, because you might get one that says bank records, you might get one that says bank reconciliation, essentially the same thing. Okay, so this is again about those sort of source documents and figuring out what goes where. Now, straight away with ones like this, if you are sort of sitting on the fence a little bit and you aren't 100% sure which way you need to go with this, get rid of the ones that you are comfortable with knowing is not relevant. So for example, I absolutely need sales invoices for VAT returns because it's the essentially the key source of where all my output tax is recorded, isn't it? So straight away, I can knock that one on the head immediately. And all of a sudden, I've cut down the potential responses by a third. I'm left with inventory records and bank records. Now, again, you need to ask yourself, well, okay, well, fundamentally, what are these? And how do they relate to tax? All these documents are important for business, but what about for VAT returns specifically? So for example, bank records and bank reconciliations, if I have to ask myself, okay, well, what will that tell me? Well, it will look at a couple of different things, won't it? Because it's dealing with my banks. So it will deal with income, expenditure, money in, money out. What money have I received? What money have I spent? Yeah, exactly. So that information from the tax element is important because, again, the reason I put bank reconciliation, you can sort of start to draw a bit of a logic here. A bank reconciliation is essentially me checking what I have in my records against what the bank seems to believe I have in my actual account. Now, the information in my accounting records has to be correct in order to make sure the information on the VAT return is correct, isn't it? If that information is wrong, and I'm in trouble, but a bank reconciliation would allow me to identify any discrepancies between what's on the accounts and what the bank is saying is actually being spent in terms of expenditure and what has been received in terms of income. That will allow me to have confidence in the information that is then put onto the VAT return. So actually I need that information. It's the inventory records that I don't need because, again, yes, it's an important figure, but for VAT purposes, again, like from like a tax point perspective, it isn't relevant. You know, there have been a multitude of different items bought on a multitude of different days. But again, the thing is, well, I've obviously I purchased the inventory, so there is a tax element attached to it, but that would be dealt with on the purchase invoices, which would be in the accounting records, which I could then check against the bank records to make sure everything matches up. Again, so you can start to draw those little strings together. So again, try and relay everything back to a tax perspective. Inventory is very, as Mahmood has just put, very important for accounts, like your statement of financial position and your statement of profit or loss, because it helps you work out your cost of sales. But for a VAT return, any VAT elements assigned to that inventory will surely be dealt with in purchases, because when I bought the stock, there will be input tax there. So with that in mind, we've got the first mark. Very, very nice. Let's have a look at the next one. Eddie has highlighted several errors that were made when the previous quarter's VAT return was produced. And it says for each of these errors, calculate the adjustments to be made to VAT. It says round your answers to the nearest penny. Now, again, in the exam, I will sort of reiterate this, and I'll mention it in the first recording, but it is worth mentioning again. The normal rounding rules apply in your exam unless you are told otherwise, okay? That is the key point. Follow the usual rounding rules like you would in any other exam, unless there is a specific question that says round down to the nearest penny, round up to the nearest pound, etc. Normal rounding rules. I'm going to keep repeating that. I will say that again on Tuesday just to be thorough as well. Okay. It's also asking me to identify the impact on VAT. So I've got two errors and a list of options for the impact. So let's look at the errors first of all. Error number one, a credit note, I'm assuming I should say note, not a credit note, to a customer for £384, including VAT, at the standard rate was not posted in the accounting software. So I've failed to post a credit note to the company's accounts. Error number two says that a purchase invoice from a supplier for £5,200, excluding VAT, at the standard rate was not posted in the software. So again, another transaction that is missing. And then I have a list of options here, and these relate to what the impact on VAT will be, okay? Either it's going to be increased output tax, increased input tax, decreased output, decrease input. So basically for output and input tax respectively, am I going to increase or decrease? So let's start with number one. Now the easiest place to start is working out what the amount is. We can worry about the impact in a second. Let's just get the figures to add up first of all. And again, this is one of those areas I can appreciate it's probably bread and butter to you guys at this point, but you have to make sure you are checking, are you given the net amount? Or are you given the gross amount? You know how to calculate both at this stage, I am sure, but make sure you spot it because it's very easy marks to drop. So for number one, that £384 includes VAT. So it's the gross amount. So within that £384, the VAT element is already present. So to find it, I'm going to do divided by 120 times by 20. Again, there's different ways you can do it. You can like divide it by 1.2, or if you have your own way, that's fine. You don't have to do it my way specifically. Different ways you can get to the same answer, but it should be £64. So let's put that in. Now I need to work out, okay, what has happened to the VAT. Now, think about what a credit note is. And a good way to remember these is think about what the sort of the traditional transaction would be. So I know a credit note to a customer relates to sales, doesn't it? So sales is output tax. We know that. And again, I'm pretty confident that you guys are intimately familiar with that at this point. So if a traditional sale increases output tax, it's not a big assumption to say anything that is essentially the opposite of sales is going to have the opposite effect on output tax, isn't it? So if a sale increases output tax, a credit note decreases it. Again, it's intrinsically the opposite effect. So what it's actually going to do is decrease output tax. And again, just be comfortable with that logic. Sales increases outputs. A credit note is essentially having the opposite effect. So it's going to decrease it. Next one. A purchase invoice from a supplier for £5,200 ex VAT at the standard rate was not posted in the software. So same again, let's just start by getting the figure done first of all, and then we can worry about the impact. Now, again, be careful. This is excluding VAT, and you will get questions like this where they will chop and change between gross and net amounts in an attempt to trip you up. £5,200. And again, it's ex VAT. So all I need to do essentially at the standard rate times by 20%. Again, you can do divided by 100 times by 20, divided by 0.2. Whatever way you want to do it is fine. But ultimately, as I can see people putting in the chat box, which is great, you should be getting the answer of £1,040. Let's put that in. 1,040. Okay, so we dealt with that. I can now deal with the tax element. Now, this one's a little easy, isn't it? Because it's a purchase invoice. Again, at this point, I'm hoping you guys are comfortable understanding that purchases would be dealing with input tax, wouldn't it? Now, this is a traditional purchase. So because of that, all it's going to do, like any other purchase, is increase our input tax, okay? It's not a trick question. If this was just like any other purchase invoice, we could reclaim the VAT element, so we can recuperate that as input tax. For argument's sake, again, just to sort of build on the logic we touched on in the first error, if this was a credit note received from a supplier, it would decrease. Again, it'd have the opposite effect. Purchases are relate to input tax. A credit note from a supplier is essentially the opposite. So there is the opposite effect to the VAT. Okay, again, just get into the groove with that. Honestly, I think that's not too bad a question though. Okay. Now let's have a look at this one. It says that Rosette Limited import goods from overseas. This is the first time Eddie has had to deal with imports, and he's a little unsure of the treatments. Which of the following statements regarding the import of goods are true or false? We've got three. Let's read them out first of all. Let's set the scene. Number one, VAT is deemed to apply at the same rate as it would have been if the goods have been purchased inside the UK. Number two, VAT can now be applied using postponed accounting, which means VAT is paid up front and then reclaimed later. Number three, VAT on import will appear in both the output and input VAT section on a VAT return. Okay, let's just start plugging into these. And again, this is where certain things, your reference material can help you a little bit, but these sort of like general true or false ones are where we start to just stretch our understanding a little bit. Okay, so number one, VAT is deemed to apply at the same rate as it would have been if goods had been purchased in the UK. Now, that is As I can see, people are putting in the chat box, which is great to see. True. Okay. Now, again, if you're an FI student, you will have seen this. It's around page, I want to say 62, 63. I know it's around there somewhere. But again, any materials you're using will essentially deal with this point. So again, we treat it as in the goods were bought inside the UK. The idea behind it is it doesn't penalise UK businesses or put them at a disadvantage. So like if you are importing, you're not being essentially penalised or punished for that. It's treated the same way as if you bought from a company based in the UK. Now, this is normally done sort of traditionally when the goods enter. Again, enter is a bit of a vague term. You know, at what point something enters is its own sort of barrel of information that truthfully isn't really the angle that the AAT are going to take. But that's the idea. So we charge the same rate, so it's fair for businesses, and it is paid at the time the goods enter into the UK. Okay. Number two, VAT can now be applied using postponed accounting, which means it is paid up front and then reclaimed later. Bit of a trickier one, this, isn't it? Now, this is just one of those. Again, I can see people have picked this up already, which is a big, big positive. Sometimes they will sort of leave these little questions where actually what they're telling you, even if you aren't 100% sure, are they actually telling you something that's factually correct? Because it's saying, okay, we've got postponed accounting. Now, the whole principle behind this is that you don't pay up front. So as I've just said there, like the traditional way of doing it, yeah, very good, Donna. So the traditional way of doing it is you pay when the goods enter the UK, you can then reclaim it on a later VAT return. The idea behind postponed is you don't pay immediately, and what you do instead is you essentially compile it all on a single VAT return. Yeah, absolutely right, Mahmood. So we don't do it earlier. We don't have to pay earlier. It's all dealt with on a single return. However, it's saying that, okay, if we use postponed accounting, it means that the VAT is paid up front and then reclaimed later. Well, again, as I've just sort of spoiled that one a little bit because I've just said that's not what postponed accounting is. This is false because factually, what it's describing there isn't postponed accounting. It's describing the original treatment, like the normal way of doing it. Postponed accounting in. So again, we don't pay up front or do not pay immediately, shall we say. Again, when I use that term immediately, I'm saying it's when the goods enter. Again, that is the traditional method. We don't pay up front like normal. Instead, what we do is we reclaim it and deal with it on a single VAT return. We'll write that down as well. I can appreciate, so you can pause the recording if you are watching the recording, or even when you get it at a later date, just so you can pick it up. Super. Okay. So this statement is a false statement, isn't it? What it's saying isn't even factually correct. So that one is completely wrong. Last but not least, number three, VAT on imports will appear in both the output and the input sections on a VAT return. Now this one is, my pen works, hello, there we go. This one is true, okay? Because again, we pay it and we can reclaim it. I can appreciate, again, what you don't get in the reference material is a big long list of what is included. The best way to get to grips with what goes in each box is to literally produce like a Word document and put box 1 includes this and that and this, scale charges, etc., etc. Box 2 includes this, box 3 includes this, and then just compile all of these things together. So remember, this one is true. You will see this in box 1. And you will see it, that's obviously for the VAT on sales. You will also see it in box 4. reclaimed on purchases. So that one is true. Again, these little true or false ones just trying to catch you off guard, okay? But pleased to know that is the end of task 4. So we are 1/3 of the way through tonight's tasks and we can move on to task 5. Now, truthfully, again, this mock 1 is quite nice. It's certainly not the hardest one you'll sit. So again, I would strongly recommend you sit as many mock assessments as possible. But I think this has probably got some of the trickiest questions. That's my opinion. You might disagree. You might find other sections are. But again, I do think this one sort of stretches you a little bit more than what you've seen in the first 4 tasks. So this task in itself is about verifying VAT returns. So it's essentially, it's almost like chapter 4, I beg your pardon, task 4.5. It just sort of continues on from that theme of dealing with VAT returns. But what we're looking at now is a couple of different sections. Again, being able to understand what goals were on a VAT return, how we can rectify errors, and the implications on payables and receivables. So that's a bit of a difference there. So we've sort of looked at errors a little bit in the last bit, but all of a sudden now there's a bit about payables and receivables. There's also a bit about the threshold for reporting errors. There's also a bit about reconciling a trial balance or the VAT account in a trial balance against the amount on a VAT return. Spoiler alert, if you have to do that, they probably won't match and you'll have to find out why, okay? And again, keep saying it, I've said it a million times on Tuesday, I'll say it a million times tonight. The reference material is your best friend with this, okay? So for the different types of reports and thresholds, just check the reference material. Make sure you're comfortable with knowing what's in there before you get to it, okay? By that I mean the exam. So again, make sure you're comfortable with what's in the reference material before you get into the exam. Okay, let's do this. Task 5. Andrew Architects. Let's get a bit more creative with the names now. We had a couple of stinkers in those first 2 tasks. They use accounting software to calculate the VAT due to or from HMRC. They don't use any specialist scheme. Okay, that's fine. The accounts assistant for Andrew Architects is reviewing the VAT return for the quarter ended 31st of October 21 before passing it on to the accountant for approval. Identify whether the following transactions should be included in box 1 or box 4 on the VAT return to October the 31st. Now, again, this is one of those. The reference material will not tell you what goes in every single box. It's worth just making a note of these things yourselves, okay? So, for example, as we just did there on that last bit of task 4, we very quickly said box 1 is like VAT due on sales, but there's other things, a couple of other things that can go in there as well that we'll see in a second. And then equal to that, we looked at box 4 was VAT reclaimed on purchases. And again, we'll see there's a couple of things that can go in there too. So just make sure you are comfortable. Even for boxes 2, 8 and 9, which we are told you will not be assessed on, I would still make sure you know what is involved in the boxes. Again, you're not going to complete a full return, but make sure you know what those boxes are about. Don't elect to ignore them completely because it might come back to bite you, okay? So let's have a look at this. Box 1 and box 4. Now, we touched on this, as I said, at the end of that task that we've just finished in task 4, box 1, we essentially refer to is VAT due on sales. But again, there's more things that we need to add there. Box 4 equals VAT reclaimed on purchases. But again, there's changes here like bad debt relief, scale charges, you know, a couple of other things. So again, just make sure you go through your notes and again, you know what the adjustments in these boxes are. What I used to have, which admittedly was on indirect tax, so needs a bit of a change, is when I was doing this as a student, I literally had a Word document and I filled in box 1, VAT due on sales, plus any of this, less any of that. And again, I just made a note of it and it's just good practice, okay? So let's start with the first one. VAT due on credit sales from the sales day book. Now, pretty obvious that one, isn't it? It's box 1, it's sales, very self-explanatory. Number 2, also looks pretty self-explanatory. VAT on purchase debit notes. I mean, again, I don't like to call them purchase debit notes. I could just say purchase invoices, to be fair. The book's trying to be a bit fancy. But yeah, obviously box 4, isn't it? VAT reclaimed on purchases. You've also got number 3. So this one may be a little less conventional. VAT on goods taken for private use. Now, what I would say as a good little tip with questions like this is if you aren't sure where it should go at face value, sometimes it can help to flip the script and look at the boxes and say, okay, I don't know which one it should go in, but can I find out or can I see which one it shouldn't go in? Is there an option here? I say, well, I was like a byproduct of elimination. If I can say, okay, well, I know it doesn't go in that box, so it has to go in the other one. It's a 50-50 shot, isn't it? So instead of taking a bit of a wild guess, if you aren't sure where it goes in the first instance, instead of looking for where it does go, weigh up the opposite way. Where doesn't it go? Because it might, again, it might be a square peg in a round hole. You found your answer. Now, goods taken for private use goes in box 1. Now, this, again, depending on the level of private use, would be proportioned as needed. Now, again, we don't need to worry about that in this question because it's not asking about if this percentage was for business use or personal use or anything like that. It's just saying if there are private use elements, it goes in box 1. It is proportioned. But again, flip the script. It's not going to go in box 4, is it? Because again, box 4 is essentially VAT reclaimed on purchases. Why would assets used for private use be reclaimed on purchases? It just doesn't make sense, does it? If I'm looking at tax at inputs and outputs, me using it privately isn't an input. Just doesn't really make sense, does it? Again, just try and flip the script and see if that helps. And the last one, again, this is a bit of a trick, bit of an interesting way of doing it. Perhaps the wording of the question could be a little clearer, but also very clearly it's not fooling anybody in the chat box, is it? VAT on the imports of goods accounted for through postponed VAT accounting. Now, we've actually just done this a little bit, haven't we? If we just very quickly scroll up to task 4, literally just did it. So it's kind of spoiling itself a little bit here. We said that any imports, we record it in both sections. So this one goes in both. Now, again, admittedly, the question could be a little clearer because it says box 1 or box 4. And it's like, haha, trick question, it goes in both. Again, I think truthfully, an AAT exam style question would make it a little clearer. Yeah, exactly, Rob. So again, it is one of those, I was wanting to pay reference to that because truthfully, that it's a little, I'm just trying to trip you up and it's not, in my opinion, particularly reflective. Okay, it should say which box, maybe like box, and then in the brackets like yes. So which box is should it be included in, and then that way you probably have a bit of a clearer reference. But again, truthfully, probably won't be an issue in your exam. Should be a little clearer than that. But we know, again, it's imports, so we deal with it in box 1 and box 4. We can pay it, we can reclaim it. Now, we've got a little bit here, and this is truthfully, I think, again, probably the hardest part of this exam, in my honest opinion. So let's see how we do. The accounting software used by Andrew Architects to calculate the VAT due to or from HMRC has recently changed. The accounts assistant has completed the draft VAT return for the quarter ended October 21. Okay. And the accountant has asked him to complete a reconciliation to the trial balance to confirm the accuracy of the figures before the return is submitted. Got some information here. So what can we ascertain? What can we discover from this? Well, it says the draft return contains the following figures. So as we can see here, I've got different amounts for each one of the boxes. Box 1, box 4, box 5, box 6, box 7. Okay, so like box 1's VAT due on sales, box 4, as we just said, is reclaimed on purchases. Box 5 is the VAT to be paid or reclaimed, basically the difference between the two. You've got box 6, which is like your sales and outputs ex VAT. You've got box 7, which is purchases and all other inputs. So again, imports and outputs. Truthfully, for this task, we're going to be focusing on these first 3 more than anything, okay? But let's continue. It says the VAT liability in the trial balance at the 31st of October has a balance of £47,120, and we have an extract of the VAT control account here. And we can see that the balance carried down is 47,120. Obviously, that would then be the balance brought down at the start of the new period to show the amount owed to HMRC as a liability. Now, it says the trial balance includes closing trade receivables totaling £124,800, all including VAT at the standard rate, and closing trade payables totaling £10,320, all including VAT at the standard rate. It's then saying, identify the reason for the difference between the VAT due in the draft VAT return and the figure on the trial balance. Basically, there's a problem here. The control account seems to think that the VAT liability sits at 47,120. Box 5, which is what the VAT return, which went on the VAT return, is the amount to be paid or reclaimed, says that that figure should be £28,040. There is a difference between the two. So again, my figures don't agree with each other, and I need to find out why. It's either because the software is using cash accounting, flat rate accounting, or annual accounting. Okay, so this is why I think this is a tricky question, because you're sort of being attacked from both fronts here. There's going to be the mathematical or the arithmetic. Honestly, I almost sound really fancy there. This is quite mathematical. The mathematical side of things, we're going to have to work out the differences and try and establish why. But then there's also like the tax theory side of it, where I need to see if I can sort of join those dots together. Clearly, what the software is saying is we are using a certain scheme. What the control account is saying is, no, that we're not using a scheme. So again, I need to find out the differences between them. So first and foremost, again, let's write those figures out. So the trial balance is saying that we owe £47,120 on the VAT return. Box 5 is saying I owe £28,040. Now, where do I even start with this? Because I can appreciate you can look at this and go, all right, well, what do I do? I've just got a load of figures. They have to give me some sort of inclination, I beg your pardon, as about what is actually happening here. I think it's quite interesting. They've given me this bit. The trial balance includes closing receivables and closing payables. And again, the question will have to do this. There's one on the AAT mocks that is incredibly similar to this. It's interesting that, isn't it, that it's saying we've established there's a difference between the trial balance and the VAT box 5, or box 5 on the VAT return. It's then also saying, oh, on the trial balance, there are these figures. Sounds like it's giving us, yeah, trade receivables and trade payables. It sounds like it's giving us maybe it's something that we need to investigate there. So what I would start by doing is saying, okay, let's look at these figures. I'm going to find the VAT element and ask myself, does this cause the difference? So I went to find those elements and find the difference. And then again, because this is sort of like a tricky question, I need to look at the different schemes as well and make sure I sort of know what I'm doing here. So for example, can I just knock any of these off right from the get-go? Well, look at this one, flat rate. Now, the flat rate scheme, which again, you will have like the information in the reference material about like thresholds and stuff, but you need to be able to explain it at face value. The flat rate scheme is where we essentially, depending on the type of service or products we make, we apply a flat percentage on inputs and outputs. Now, to me, without even looking at anything else, I can say, okay, how am I supposed to know that the flat scheme is being used here when the question has given me literally no reference to any percentages used? it can't be the flat rate scheme because, again, ask yourself, how would you work this out when you are told absolutely nothing in the material given to you? I have no suggestions, no comments that would imply any percentages have been applied. And, maybe, there would have been a difference of, like 6% or 7%. But again, look for the breadcrumbs in the question. And as Donna said there, this is why we're going to look at finding the VAT elements, because it's saying here, isn't it, at the standard rate. So again, breadcrumbs in the question. If it was at the flat rate, these wouldn't be at the standard rate, would they? So again, finding the VAT elements is really, really important. So with that, I'm left with cash and annual. Now, again, annual doesn't really sort of fit the bill here, does it? Annual is sort of more to do with when we pay, as opposed to like the sort of method used. And you can actually use cash accounting or flat rate, not both, one or the other, under the annual scheme as well. This one's looking almightily interesting to me. So let's have a look at this. So we know the differences with the trial balances are as follows. Let's find those VAT elements, shall we? So again, this is a good chance, good practice for you guys as well, just getting comfortable with your net and gross amounts. Trade receivables, £124,800, including VAT. £124,800. Again, you can do it by different ways, divided by 1.2, whatever way you want to do, it's fine. Equals 20,800. So within that £124,800, 20,800 relates to VAT. Okay, again, that's the gross amount. Be very, very careful of that. And it sounds like I'm being really pedantic, but it is important. Okay. So that was for trade receivables. What about trade payables? 10,320, again, including VAT at the standard rate. Let's find out what that figure comes to. So again, 10,000, I'll try and keep it all on one screen, there you go, 10,320. And again, just work out the gross amount using your preferred calculation. Gives me a total, well, the Mahmuda of £1,720. So we found the VAT elements for trade receivables and trade payables, respectively. So now what I need to do is say, okay, what do these equal? Now, of course, purchases is input tax, so I will offset those against each other. 20,800 minus 1,720 equals a total, thank you, Rob, of £19,080. Now, the final piece of the puzzle is if I look at these two figures here and ask myself, what is the difference and does it agree? Because if the difference between these figures agrees, then I'm pretty much there in terms of finding this out. And again, if you do, £47,120 minus that 28,040, you will get to the difference, £19,080. Yeah, absolutely, Donna. So that 19,000 has come from my trade receivables less my trade payables, okay? Because remember, it's the same when you deal with it on a VAT return, just on like a miniature level. The sales is output tax. I will then offset my input tax, aka the purchase element, against it. So I'm doing that 20,800 minus the 1,720. Again, I'm just doing the output minus the input like you normally would, but just on a sort of a specific level. And that explains the difference, doesn't it? So the reason there is a difference is to do with the trade receivables and trade payables. And we are nearly there. Final piece in the puzzle, again, you need to be comfortable with your tax theory here as well. So I found out why that is the case. So all I need to do now is say, so what have we got left? We've got cash accounting and annual accounting. Now, is there one of these tax methods or tax schemes, I beg your pardon, that I can use where the payables and receivables, the tax elements, would be dealt with slightly differently? And again, this is where your tax knowledge comes in, because it relates to cash accounting. Remember, with cash accounting, but the key element of the scheme is we account for VAT when it is paid or received. So again, when we receive cash or when we pay cash, that is when we deal with the VAT element. Trade receivables and trade payables, we have not received the money yet, have we? It's recorded in our accounts like normal, but again, it wouldn't be recorded on the VAT return if we were using the cash accounting scheme, because we haven't paid or received that money yet. So that is what the difference is. Again, a bit of a tricky one that I must admit. It's not particularly straightforward, but again, the trick is just to understand what we're saying there. Trade payables and trade receivables. If a company or if it was set up to use the cash accounting scheme, they wouldn't be on there because I haven't paid and I haven't received. Must have a good cash flow. Yeah, it's one of those, again, that for sort of smaller businesses, it can work to a degree. Yeah, a lot of, obviously, for large companies, they can't do it anyway. They won't be allowed to register. But again, cash accounting, having good cash flows is a very fine balancing act, shall we say. And what we can do is the last little bit, which, to be fair, we've already done this, but we will just reiterate it, is it says complete the table below to reconcile the figures in the draft VAT return. Apologies, my mouse is having a bit of a moment there. Let me just reset that. Is it back? There it is. Sorry about that. My mouse just completely shut off there and everything froze. Complete the table below to reconcile the figures in the draft VAT return to the figure in the trial balance. We've just done this, haven't we? So what we've just said is we added on output tax, output VAT, and our trade receivables. We worked that out as 20,800. We also had the input VAT on the purchases. So the input on trade payables, which was, you knew, as a minus figure, which got us to that amount, okay? And that's it. Again, all we've done there is literally a slightly different way of writing it out as we did there. So I've got a couple of different ways you can get there, but you'll still find you get to the same answer regardless. Now, we've got one little bit left to do and about 10-15 minutes to do it in. Truthfully, this is probably the nicest task. We've gone from the trickiest to the easiest, because this is literally just check the reference material quite a lot. It will be your best friend in this one. So it says that task 6, it deals with rules on record filing, record keeping, beg your pardon, filing and payments and repayments, including non-compliance implications. Task is worth 11 marks, meaning you have approximately 12 minutes to complete it. Again, just use the times as a rough guide. It's based proportionately off the amount of marks in the task weighed up against the amount of marks in the total assessment weighed up against the amount of time you have available. Use it as a rough guide. Please don't. If you do it in 30 minutes, it's fine. You know your own time a lot better. So what do we need to know? Again, we need to understand key documentation for VAT registration this time, not VAT returns. So again, documentation. Being aware of key dates for filing, payments, repayments, and the subsequent implications of non-compliance. Explain how long records are required to be retained and kept. Implications of what happens if we fail to register. Be able to calculate penalties and surcharges. honestly, this one, the reference material, again, will cover essentially everything that comes up. Well, essentially everything, not definitely. Again, there might be a couple of stretches we have to make, but by and large, the reference material really is your best friend in this one, okay? Okay, let's have a look. Let's get this done. Part A, identify whether the following statements about VAT legal requirements are true or false. More true or false? Goody goody. Okay, let's do number one. VAT returns that are due quarterly, that is outside of any special accounting schemes, are required to be submitted 1 month and 3 days after the end of the VAT period. How am I supposed to remember that? Spoiler alert. Check the reference material. It's in there, okay? I'm going to say that a lot in this task. I'm going to go check the reference material. I'm probably going to get it tattooed at this point. It's not true. How do you know that? Check the reference material. You will see that it's actually 1 month, 7 days. Yeah, thank you, Rob. 1 month and 7 days, not 3. Again, just take the time to check the reference material, because when you're sort of in an exam, you may be a little pressed for time. You can very easily go, yeah, and just skip over it, because it does happen. So just take 10 seconds to check the material, okay? Let's have a look at this one. Number 2. HMRC will record a default if a VAT return is not filed by the deadline or if full payment is not made by the due date. So it's saying they will record a default if a VAT return is not filed by the deadline or if a full payment is not made by the due date. Spoiler alert. Information on defaults is listed in the reference material, and you will be told that defaults apply if you fail to make payments by the deadline or if they are for an inadequate amount. So that statement is true. Thank you, reference material. Number 3, HMRC may charge penalty, I'm sure that should say either a penalty or penalties. Somebody was having a bad day when they wrote this mock. HMRC may charge a penalty for deliberate and concealed, I should say, inaccuracies, how ironic is that, inaccuracies, up to 100% of potential lost revenue. Now, spelling mistakes aside, let's just reread that. HMRC may charge a penalty for deliberate and concealed errors, concealed inaccuracies, up to 100% of potential lost revenue. If you're trying to remember what the surcharges are, you'll never guess where you can find them. You are right, Donna. Would you believe it? What a plot twist. Have a look in the reference materials. It's there. And you honestly, it's not going to have everything in there in the exam, but you are going to be pleasantly surprised. There are situations where you'll just check it, put the answer in, you've got a mark, okay? So again, the different types of surcharges, because again, perhaps the only trick is with this is just be careful, okay? But again, the reference material will sort of give you everything that you need to know for this, okay? So what I will do very quickly is, let me just get this down just to make a point. Will it let me? Yes, give me 2 seconds, guys. I'm just trying to bring something down to this, a second screen for you guys to see. There we go. So there's a little section here on deliberate and concealed. Just be careful, again, because the percentages, again, if it's prompted or unprompted or whatever, deliberate and concealed are 2 separate entities. So then that's the only mistake you might make with this. Just make sure you pick the right one. The question is saying this is a deliberate, should say, and concealed error. So they do have up to 100% fines, okay? Deliberate, be it unprompted or prompted, again, you'll see in the reference material, is capped at 70%. Concealed errors are capped at 100. Well, not even capped, okay, it goes up to 100. So again, just check the material, it's all there for you, okay? Last but not least, number 4. Interest on VAT outstanding may be charged by HMRC if less VAT is reported than is due at a rate of 2.6%. Now this one is true. And this one, that 2.6%, is in the reference material. It is in there, okay? So again, you can just scroll over to it, find it, you're good to go, okay? 4 easy marks there. Last couple of bits, let's keep going. We should be finished in the next 5-ish minutes. Farndale Florists Limited started to trade on the 1st of June 21 and registered for VAT on that date. To sign up for Making Tax Digital, Farndale requires several pieces of information to complete the registration process. It says which 3 of the following are required to complete the process. Now, it's again, just to make it clear, this is the registration process for Making Tax Digital, not the registration process for to become like VAT registered or to join a certain scheme. Because how could we become? But how would you, when you're looking at this, goes like registration number. If I'm applying to register, I won't have a number, will I? So again, it's saying to register for MTD, not to register for VAT. Just be careful with that. Again, we will try and throw those little curveballs in. So just make sure you're on ball with it, on the ball, I should say. Now, this is one of the very few parts of this task that isn't in the reference material, okay? However, the answers are still moderately easy to point out here. We're talking about Farndale Florists Limited, okay? So again, we are dealing with a limited company. Is there anything on here that, as I'm looking at it, doesn't fit that bill? So number 1, we'll say is company registration number and a unique taxpayer reference. Number 2 is the VAT registration number. Number 3, national insurance number. Number 4, a unique taxpayer's reference and the postcode where you are registered for self-assessments. Number 5, VAT registration date. Now, Rob's picked up one of those straight away. National insurance number. The companies don't have national insurance numbers, do they? You have a national insurance number. It's individual, isn't it? It's not for companies. So straight away, we can knock that one off. So there must be 1 out of the remaining 4 that is also not correct. And Donna has done a great job of finding the other one. It says unique taxpayer's reference and the postcode where you are registered for self-assessments. Now again, limited companies do not undergo self-assessment like that. This is relating to things like partnerships, isn't it? Because the tax rules are different for those. Again, for those of you with bigger dreams of level 4, when you come to do personal tax and business tax, you look at the differences. So personal tax will look a little bit of detail about that, again, the personal side of it. So things like capital gains tax, income tax, etc. Business tax looks at things like limited companies, corporation tax, or what we call like incorporated entities. Self-assessment is not something that is completed by a limited company. Again, it's different, it's individualistic. It is not to do with limited companies. What is to do with limited companies is they'll have a registration number and a UTR. Again, they will still have a reference, but the trick is not for self-assessment. They'll have a registration number because, again, if they are applying for Making Tax, or registering, I beg your pardon, for Making Tax Digital, they'll already have all this set up, or they should do. And the date that they initially registered, okay? And it's an interesting one, this, because by the time this syllabus ends, Making Tax Digital won't be like something companies have to register for. It should all be done at this point. It's been banging on for quite a while now. So this will just sort of pop up for a couple of years and then disappear into the sunset. Okay, last couple of bits. We're nearly there, guys. Ding Dong Clocks, that's the best one yet, isn't it? Operates an annual accounting scheme and output tax always exceeds input tax. Okay. The VAT period ends on the 28th of February, and Ding Dong Clocks Limited makes monthly VAT payments. Identify whether each of the following statements is true or false. Goody, more true or false questions, aren't we lucky? Spoiler alert, things to do with the annual accounting scheme, the differences about them can be found, have a guess, in the reference material. Okay, so like the thresholds, payment dates, due dates, the amount of payments, settling balances, etc. All the sort of the nuances of the rule can be found in there. Okay, so again, you'll have the reference material in the exam. You would have it up on the screen. You'd be able to use that as a reference point for such a question. Statement number 1. Ding Dong Clocks must make 12 monthly payments per annum. Basically means per year. Okay. Yeah. Well done, Donna. Well done, guys. Yeah, it's false, isn't it? They will make 9 payments. Again, as confirmed in the reference material. Number 2, the due date for the final balancing payment will be due at the end of the 31st of March. So I need to check the dates you don't have. So they're saying the period ends on the 28th of February, okay? I'm saying here that will be due on the 31st of March. Okay, so again, I can see people have immediately spotted this and said, oh, no, that's false. Okay, well, let me turn the screw on you guys a little bit. Why? So why is that false? Because it's a month after, isn't it? Yeah, exactly, guys. Check the rules, check the reference material. It's actually 2 months. And again, as confirmed, as you will be able to see in your reference material in the exam. So that statement, it's nearly right, but it isn't quite there, is it? It is false. Number 3, Ding Dong Clocks must make 9 interim payments, estimated to 20% of the VAT bill, based on the previous returns per year. Well spotted, Rob. Now again, check the reference material. Yes, they will make interim payments, but the interim payments are for 10%. That is false. Last but not least, the deadline for the submission of the annual returns is the 30th of April. Well, I know it ends in February. And I know that I have to pay 2 months after. What comes 2 months after February? March, April. Correct. Now, again, I will get it up quickly on my screen just so you guys can see it. Let me bring this down. Again, everything that we've just done is all there. Okay, again, then this you will have this extract of the reference material in the assessment. Again, 2 months after the end of the accounting period. Okay, 2 months after the end, balancing payments are due here. Just be careful, but again, you can see, is it paid monthly? Is it paid quarterly? We are paid monthly in the question we've just done, but again, the question has to tell you, you can't be expected to guess. And it has the slightly different payment types or differences in how you paid, etc., in the reference material. Oh, I thought I threw it to the other screen then. Go away. There we go. I was trying to put it on my second screen. It just kept coming back. Okay, but with that, you're pleased to know we're done. That is tasks 4, 5, and 6. So what I'm going to do very quickly is just stop the recording.